Hi, and welcome to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. I'm going to be reporting flows for the conventional fund business. We'll talk about ETFs later on for the week ended Wednesday, August 14th, 2013. I think you'd be surprised that even though we saw one of the worst weeks we've seen since June, we saw actually performance where we saw a triple-digit decline on Friday for the Dow. And we also saw the first week in 6 where we saw negative performance. The Dow had about a 1.49% return. That actually investors were net purchasers of mutual fund assets. About $8.3 billion entered the conventional fund business via mutual funds this week. Let's see how that panned out in our macro group and how that occurred. Equity funds saw about $2.6 billion in net new money come into their coffers. Taxable bond funds saw about $1.3 billion in net new money. Money market funds saw about $5.7 billion of net new money. And of course, the pariah for the 12th consecutive week was muni bond funds. They saw about $1.2 billion in outflows. And as we drill down, we can take a look at how equity funds actually contributed to the net inflows. We saw about a 0.45% return, the second consecutive week that we've actually seen plus side performance, and the 32nd consecutive week that we've seen net inflows. Year to date, $130.5 billion have entered the coffers of equity funds, and how it broke out this week is domestic equity funds took in about $1 billion in net new money, while non-domestic equity funds saw about $1.6 billion in net new money come to their coffers. You know, it's interesting as we break this out, we saw that gold and natural resources funds actually took in about $300 million in net new money, and the international equity funds, not necessarily emerging market funds, saw about $1.5 billion of inflows for that group as well, and only about $300 million of money came into the emerging markets. It's a little bit of change. We've been seeing a lot of flows going into emerging market funds as of late. That's changed. People have gotten a little bit more comfortable putting money to work back in European region funds and other international plays other than just emerging markets. Let's take a look now at what happened to the equity ETF side fund, because this is where we saw a dichotomy, a tale of two cities, as we've been seeing going on and off over the last several weeks. For the first week in 7, we saw outflows out of equity ETFs, about $1.6 billion. And here is really kind of the crazy part. SPY saw about $1.8 billion on outflows, but then on the flip side, we saw the iShare Core S&P 500 fund basically take in $440 million. So there was conflicting views on what was going to be hot and what was not. And then we get down to the bottom line, we saw the Russell 2000 lose about $1 billion, and we saw Financial Select Spider Fund actually lose about $420 million as well. So people were making bets in kind of weird areas, but when we saw the outflows, it really was kind of a risk-off type of move. Again, Russell 2000 taking or losing about $1 billion of money there. Let's take a look at our fixed income side, because this was kind of a change of pace as well. For the second consecutive week, we saw inflows, $1.3 billion of money coming into their coffers. For the second week in 3, though, we've seen negative performance, 0.09% loss. Loan participation funds were really the great asset attractor, $1.3 billion of money going into their coffers, and we saw flexible portfolio funds take in a little bit less than $1 billion. It was $900 and some million net new money coming there. Big losers, though, was the government treasury and mortgage-backed funds. They basically saw $407 billion in outflows. Well, if we take a different focus and then start looking back again at how the ETFs behaved, it was very similar in flows. We saw about $100 million, actually turned out to be about $60 million total money enter the ETFs. It's a small universe as well. But where we saw the big moves was the iShares 20-plus Treasury taking in about $270 million. But on the flip side, when we took a look at it, we saw high-yield funds and Treasury inflation-protected securities or other inflation-protected securities actually lose money. And again, floating rates were at the top of the group as well. So very similar to the open-end brothers. When we take a look, though, now at the pariah for the 12th consecutive week, we basically are seeing muni bond funds suffering from a hangover from the Detroit bankruptcy. And of course, the comments by Meredith Whitney has also been, keeping people basically away from this group as well. For the second consecutive week, we saw that there was negative performance, 0.37% return, and the big pariah, the big group that was actually the detractor of assets was the National Muni Fund. So about $900 million of money exit their coffers. Now, if we take a look at money market funds, funds. We know there's not big trends there. It kind of is off and on, but we saw $5.7 billion net new money enter that group. And of course, if people are a little bit on the fence, a little bit concerned about what's going on, whether it be Fed tapering or whether they're seeing some volatility in the markets, they're going to put money back in the money market funds. We saw that for the second week. That's the second week that we've seen inflows out of this group. Taxable money market funds basically saw $6.2 billion of net new money enter their group. How we broke that out, those institutional funds saw about $6.3 billion net new money, while the retail group only saw about $100 million of outflows. And of course, as we get to the tax exempt side, we saw about $500 million in outflows there. Well, as we move forward, we're going to be taking a look at what happened today. We saw housing starts were actually 5.9%, up 5.9% in July is very good numbers. And we also saw that the second quarter non-farm productivity actually increased about 0.9%. That was on the surprise side. So we'll keep an eye on the details. We know that the earnings reports are basically over. We've got obviously some left, but the majority of them are in. And then really I think what investors are going to do is focus back on the economic indicators, so that way they can at least try to feel out where the Fed may go in. Well, if you want to do a deeper dive and check into the fund flows yourself, you can go to lipperusfundflows.com to get a deeper dive, or join us next week where one of our analysts will talk to you about the flows trends. Thanks for joining us. My name's Tom Rosine, wishing you the best in your wealth planning and creation.